Jill, thanks for being with us today. I mean, when you calculate it like that, 267 years to reach gender parity in employment and education, I mean, it makes my brain hurt. What did your research yield?
Yeah, thanks for having me. I think there's been obviously a ton of research out there about the economic implications of the wage gap and inequality with respect to gender and other factors and the economic implications there. COVID also exacerbated many of these factors, had a regressive impact on women and minorities. So we have seen some slowing in progress in terms of, the number of years to reach economic parity in employment and education, more so versus a year ago. But we've also found some interesting takeaways at the corporate level. And, unfortunately, we've seen a slowing of progress there in terms of, the number of women on boards, as you mentioned, for when we look at either S&P 500 companies or even smaller cap companies, the stats were pretty much little changed versus a year ago. And even though they are up from a decade ago and progress has improved, we haven't seen much progress in the past year or so. So, I think the implications for this is that, a focus on diversity and equity and inclusion matters. We've actually seen that show up in financial results. So companies that have more women on boards or more women in management or focus more on diversity and equity and inclusion related programs have actually seen, lower earnings volatility, stronger subsequent returns on equity, and often premium valuation multiples to peers.
So that's the investment case for why you'd want to see more gender and more diversity efforts, because you're talking about higher multiples, at least where small caps are concerned, and you're talking about a better return on equity. What I found surprising in your report was that the quote unquote new economy sectors tend to lag the old economy sectors when it comes to these types of policies and benefits.
Yeah, when we looked at the sector level, some of what you might consider new economy sectors like tech and communication services and healthcare lag some of the more traditional sectors on diversity, equity, and inclusion policies and benefits, even though they have better gender diversity at the board level or in their workforces. So that was one implication we saw at the sector level. When we've looked more broadly at sectors in terms of who's ahead and who's behind, utilities has generally been one that within both large and small caps has tended to see better, gender diversity at the board level, has ranked a bit better on some of these diversity, equity, and inclusion metrics, whereas energy is one sector at the other end of the spectrum that's been a bit further behind and may have more catching up to do. So certainly a lot of room for progress, a lot of room for this to have implications on subsequent financial results, as mentioned. And, really we've seen that it can impact performance as well. Companies that have had Me Too type controversies, we've seen significant underperformance relative to the market. We've seen, based on Glassdoor data, that companies that have better culture scores, this has been a big driver of employee satisfaction and often more so than compensation. So I think focusing on these factors has very clear implications for financial results, for employee satisfaction, and in many cases for performance.
Well, Jill Carey Hall, we appreciate your insights and your research. Thank you for joining us to break it down for us.